Alright, so let's talk about investing. Welcome to the next episode of Financial Verse by Multiverse Mania. A lot of people have this idea that you need a ton of money to even think about getting started. You see these finance gurus online talking about their massive portfolios, their six-figure stock market gains, and you think, well, I've only got $100, what's the point? Let me tell you right now, that thinking is completely wrong. That $100 is more than enough to get your foot in the door and start building a foundation for your financial future. It's not about how much you start with, it's about the habits you build from day one. Think you need thousands to start investing? Think again. In 2025 you can start investing with just $100 and still build real wealth over time. This isn't about some get-rich-quick crypto pump and dump scheme. This is about taking a small, manageable amount of money and putting it to work for you, smartly and consistently. The power of compounding is real, and it works just as well on $100 as it does on $100,000, it just needs time. It's all about getting started, and today, that's exactly what we're going to do. Whether you're a student, freelancer, or a 9-to-5 worker, today's video will show you how to invest your first $100 the smart way. No fluff, no jargon. We're going to break down every single step, from the right mindset to have, to exactly where to put that money, and the common mistakes you absolutely need to avoid. By the end of this video, you'll have a clear, actionable plan to turn that $100 into the start of something much, much bigger. Let's get started. Before we even touch that $100, we need to get one thing straight. This is probably the most important part of the entire video, so listen up. Investing is not a lottery ticket. It is not a way to get rich by next Tuesday. If you're coming into this thinking you're going to triple your money in a week, you're setting yourself up for failure and disappointment. The real secret to building wealth through investing is time and consistency. It's about playing the long game. You have to think in terms of years, even decades, not days or weeks. That $100 is a seed you're planting today, and you need to give it time to grow into a tree. The goal here isn't to become a day trader, glued to your screen, stressing over every little market fluctuation. That's a recipe for anxiety and frankly losing money. The goal is to become a long-term investor. This means you buy and you hold. You trust the process. Starting small with $100 is actually a huge advantage because it allows you to learn the ropes without a lot of risk. You can get comfortable with how the market moves, build the habit of putting money aside regularly, and do it all without losing sleep at night. Stay slow, stay consistent, and you will win. Okay, mindset is locked in. Now for the practical stuff. To invest that $100, you need a place to do it, and that place is called a brokerage account. Think of it like a special bank account just for buying and selling stocks, ETFs, and other investments. Now in the past, this was a complicated process with high fees and big minimum deposit requirements, but today it's incredibly easy and most importantly free to get started. There are so many beginner-friendly platforms out there that are designed specifically for people like us who are just getting started. Platforms like Robinhood, Webull, and SoFi Invest are fantastic options in many countries because they have no account minimums. That means you can open an account with $0 and then fund it with your $100. For my viewers in Pakistan, you'll want to look for MRA-registered brokers that offer user-friendly online platforms. The key feature you're looking for, besides no minimum balance, is fractional shares. This is a game changer. It means you can buy a small piece of an expensive stock. So even if one share of a company like Amazon costs thousands, you can still invest your $5 or $10 into it. This lets you own a piece of the best companies in the world, even with a small budget. So you've got your account open, and your $100 is sitting there, ready to go. The big question is, what do you actually buy? With just $100, you don't want to put it all on one single company. That's like betting everything on one horse in a race. It's way too risky. The magic word here is diversification. You want to spread your money out across many different companies and industries. This way, if one company does poorly, it doesn't wipe out your entire investment. The easiest way to do this is by buying an ETF, which stands for Exchange Traded Fund. Think of an ETF as a basket that holds hundreds or even thousands of different stocks all bundled together. When you buy one share of an ETF, you're instantly diversified. For a beginner, I'd recommend looking at a broad market index fund ETF, like one that tracks the S&P 500. This gives you a small piece of the 500 largest companies in the US. Alternatively, you can use those fractional shares we talked about. You could take your $100 and put say $20 into Apple, $20 into Microsoft, $20 into an S&P 500 ETF, and so on. This also achieves diversification and lets you own companies you know and believe in for the long term. Now that you've made your first investment, what's next? You don't just set it and forget it entirely. The key to long-term success is consistency, and the best strategy for this is called dollar cost averaging, or DCA. It sounds complicated, but it's actually incredibly simple. All it means is that you invest a fixed amount of money at regular intervals, no matter what the market is doing. So you invested your first $100 this month. Next month, you invest another fixed amount. Maybe it's $25 or $50 or even just $10. You do this every single month or every 2 weeks, whatever works for you. The genius of this strategy is that it takes emotion completely out of the equation. You're not trying to time the market, which is nearly impossible anyway. When the market is down, your fixed amount buys you more shares. When the market is up, it buys you fewer shares. Over time, this averages out your purchase price and smooths out the bumps. It forces you to buy when prices are low, which is exactly what smart investors do. It's a disciplined approach that turns market volatility into an advantage for you, rather than a source of stress and panic. Your initial investment is done and you have a strategy in place, but your journey doesn't stop here. Investing is a skill, and like any skill, the more you learn, the better you'll get. You've taken the first step, which is honestly the hardest, but now it's time to build your knowledge base. You don't need to become a Wall Street analyst, but you should have a basic understanding of what you're investing in and why. The good news is, there's a universe of free, high-quality information out there just waiting for you. Start by continuing to watch channels like this one on YouTube. Find a few creators who explain things in a way that makes sense to you. Beyond that, consider reading some classic investing books. The Simple Path to Wealth by J.L. Collins or The Little Book of Common Sense Investing by John Bogle are fantastic starting points that really reinforce the long-term, simple approach. You can also use apps like Yahoo Finance or your own brokerage's app to track your investments and read up on the companies or funds you own. The goal is to build your confidence through knowledge so you're not swayed by fear or hype. As you get more comfortable, you're going to be tempted to make certain moves. Let's talk about the traps you need to avoid at all costs, especially as a beginner. The first one is chasing hype. You'll see a stock on the news or on social media that's gone up 500% in a month, and you'll get a major case of FOMO, fear of missing out. You'll want to jump in. Don't do it. By the time you hear about it, you're likely too late, and these stocks are incredibly volatile. Stick to your plan of investing in solid, diversified assets for the long term. The second mistake is investing money you can't afford to lose. The money you invest should be separate from your emergency fund or money you need for rent next month. The market goes up and down and you need to be able to leave that money invested, even during a downturn, without it affecting your daily life. And that leads to the third mistake, panic selling. The market will crash. It's not a matter of if, but when. When it does, your portfolio will go down. Your gut reaction will be to sell everything to stop the bleeding. This is the worst thing you can do. Market dips are sales. They are opportunities to buy great assets at a discount. Remember, you're in this for the long haul. Alright, here's a bonus tip that will pour gasoline on your wealth-building fire. It's the concept that Albert Einstein supposedly called the eighth wonder of the world: compound interest. When your investments make money, either through the stock price going up or by paying out dividends, you have two choices. You can take that money out and spend it, or you can reinvest it. You absolutely want to reinvest it. Most brokerage platforms have a feature you can turn on called DRIP, which stands for Dividend Reinvestment Plan. Turn it on. When you reinvest your returns, your new, slightly larger investment starts earning its own returns. It's like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow, getting bigger and bigger and picking up even more snow, faster and faster. This is how your $100 can truly grow into a significant amount of money over time. It's your earnings earning their own earnings. It might not seem like much in the first year or two, but over 10, 20, or 30 years, the effect of compounding is absolutely massive and is the true secret to building wealth in the stock market. And there you have it. A complete step-by-step guide to investing your very first $100. It's not about being a genius or taking massive risks. It's about having the right mindset, being consistent, staying diversified, and letting the magic of compounding do the heavy lifting for you over the long term. That $100 isn't just $100 anymore, it's a statement. It's you taking control of your financial future and deciding that you're going to build something for yourself, one small, smart investment at a time. The journey of 1,000 miles begins with a single step, and you have just taken it. Don't let perfection be the enemy of good. You don't need to know everything to get started. You just need to start. The plan we laid out today is simple, effective, and the perfect way to get your feet wet in the world of investing. Remember to be patient, keep learning, and stick to your strategy, especially when the market gets a little rocky. The habits you build today with this first $100 will be the same habits that will manage your portfolio when it's worth thousands or even hundreds of thousands of dollars down the road. With just $100, you've taken your first step into the world of investing. Which platform or strategy are you going to try first? Drop a comment below, and don't forget to subscribe for more beginner-friendly finance tips every single week.